In the final years of the 18th century, the United States existed more as an idea than a machine. Its borders were uncertain, its institutions fragile, and its finances dangerously exposed. Victory in the Revolutionary War had delivered independence, but it had also delivered debt, heavy, unresolved, and deeply political. The new nation owed money to foreign allies, to domestic lenders, and to its own soldiers. There was no single national currency strong enough to command trust. Instead, a chaotic mix of foreign coins, private banknotes, and promissory paper flowed through markets like an uncontrolled tide. In taverns and trading posts, Spanish dollars passed alongside British shillings, their edges clipped, their origins ignored. Value was improvised, negotiated face to face, weighed not only by metal but by reputation. Behind this disorder, power was quietly concentrating. Merchants, lenders, and early financiers understood something the public did not. Whoever defined money would shape the future of the republic. In dim rooms thick with smoke and ink, ledgers recorded more than numbers. They recorded influence. Alexander Hamilton, the first Secretary of the Treasury, watched this chaos with calculated concern. To him, unstable money was not merely inconvenient, it was existentially dangerous. A nation without a unified currency could not project authority, could not borrow reliably, and could not compete in a world dominated by empires whose financial systems were already centuries old. The Coinage Act of 1792 was born from this fear. On its surface, it appeared technical, almost mundane, definitions, measurements, procedures. But beneath its legal language lay a radical attempt to hardwire trust into the system. The act defined the dollar not as an abstract promise, but as a specific weight of precious metal. Silver was primary, gold secondary, both measured with mathematical precision. $1 equaled a fixed number of grains of silver. Gold coins were defined just as strictly. In theory, this removed discretion, manipulation, and politics from money. Value would be locked into physics itself. The atmosphere surrounding the act was almost ritualistic. Imagine heavy presses inside the first U.S. Mint, metal blanks laid out like offerings, officials inspecting weights under lantern light. Each strike of the die was meant to signal order replacing chaos. This was not just currency creation, it was nation building. The founders believed that by tying money to metal, they could prevent the kind of financial abuse that had plagued Europe, where kings debased coins to fund wars and bankers quietly rewrote the rules. Yet even as the law passed, tension flickered beneath the surface. The act established a bimetallic standard, fixing a ratio between gold and silver that assumed global markets would remain stable. They would not. Europe's appetite for silver, driven by trade with Asia, began to distort prices almost immediately. Silver became more valuable abroad than at home. Gold, undervalued by the fixed ratio, slipped out of circulation. It was melted, exported, or hoarded. The law had spoken clearly, but markets answered in whispers. This was the first quiet lesson in hidden finance. When law and incentive diverge, capital moves silently. Ordinary citizens saw coins disappear and paper replace them. Financiers saw opportunity. They learned how to arbitrage the difference between legal value and market value. They learned that information traveled faster than legislation. The Coinage Act had tried to freeze value in place, but value, by nature, flows toward advantage. Banks quickly became the intermediaries of this new reality. While the act envisioned money as metal passing hand to hand, banks introduced distance. Deposits replaced possession. Paper claims replaced coins. Inside early bank vaults, gold and silver sat stacked behind iron doors, rarely touched, while notes multiplied far beyond the metal backing them. To the public, this looked like progress. To those watching closely, it looked like leverage. The act had not forbidden paper money. It had assumed metal would discipline it. But discipline requires visibility, and visibility faded as finance grew more complex. A farmer might hold a note promising redemption in silver, yet never attempt to redeem it. Trust replaced verification. The system worked until it didn't. Bank runs exposed the fragility beneath the polished counters and formal language.
Politically, the Coinage Act became a symbol wielded by all sides. To some, it represented honest money and republican virtue. To others, it was an obstacle to growth, too rigid for an expanding economy. Debates over currency were never just about metal, they were about who benefited from stability and who benefited from flexibility. Creditors preferred gold, debtors preferred silver, banks preferred paper. Each faction claimed the moral high ground, invoking the act while quietly working around it. Visually, the era feels split between clarity and shadow. On one side, gleaming coins, scales and official seals, symbols of order. On the other, back rooms where notes were discounted, loans extended, and futures quietly bet upon. The Coinage Act sat at the center like a spotlight, illuminating principles while casting long shadows behind them. By the early 1800s, it was already clear that the act had done something unexpected. It had created a standard everyone referenced, but few fully obeyed. It had centralized the definition of money, but not its control. That control migrated to banks, to markets, to those who understood timing better than statutes. The law gave America a dollar, but it also revealed how easily the meaning of that dollar could be bent without changing a single word of legislation. As the young nation pushed westward and commerce accelerated, the gap between written law and lived finance widened. The Coinage Act remained intact, its language untouched, while the system built around it evolved into something far more complex and opaque. What began as an attempt to protect the public from hidden manipulation became the foundation upon which new, quieter forms of control would be built. And as gold slowly slipped from everyday hands into guarded vaults, a subtle transition began, one that would reshape American money forever, even as most citizens believed the original promise still held.
By the time the 19th century gathered momentum, the promise of the Coinage Act of 1792 was already fading into abstraction. Its words still lived on parchment, its measurements still precise, yet the economy moving beneath it had grown faster, louder, and far more ambitious than its authors ever imagined. America was no longer a fragile experiment hugging the Atlantic coast. It was expanding, industrializing, and consuming credit at a scale that metal alone could not satisfy. In this new environment, gold and silver were less a circulating reality and more a psychological anchor, invoked to maintain confidence while being quietly withdrawn from daily life. Banks multiplied along canals and rail lines, their facades projecting solidity while their balance sheets told more complicated stories. Inside these institutions, lamplight reflected off stacked ledgers and locked drawers, where metal reserves were counted carefully, not because they would be used, but because they justified expansion. A single silver dollar could now support multiple claims. Paper money, once a convenience, became the bloodstream of commerce. The Coinage Act had defined money as weight, but banking had redefined it as promise. This shift created a subtle inversion of power. Instead of metal disciplining credit, credit began to discipline metal. Gold and silver were held back, conserved, mobilized strategically during moments of stress. Ordinary citizens might go years without seeing a gold coin, yet were told their paper was as good as gold. The phrase itself revealed the transformation. Gold was no longer money in motion, it was a symbol standing behind a curtain. Global forces intensified this divide. As Europe industrialized and global trade surged, precious metals flowed across borders in response to demand rather than law. Silver streamed toward Asia, gold pooled in financial centers. The fixed ratios of the Coinage Act became increasingly misaligned with reality. Congress adjusted coinage weights, suspended certain metals, and passed revisions meant to stabilize the system. Each adjustment, though technical, signaled retreat from the Act's original clarity. For financiers, these distortions were not failures, but openings. Information became the most valuable asset. Those who knew when ratios would change, when shipments would arrive, or when legislation was imminent, could position themselves ahead of the public. Metal moved quietly between vaults and ports, often invisible to the very people whose currency was supposedly defined by it. The hidden financial world was taking shape, not through secrecy alone, but through complexity. Political rhetoric grew sharper. Monetary debates were framed as moral struggles, yet they masked deeper structural shifts.
When silver advocates demanded expanded coinage, they spoke of fairness and access. When gold supporters insisted on restraint, they spoke of stability and credibility. But beneath both arguments lay an unspoken reality. Control had already drifted away from metallic law toward institutional management. The Coinage Act was cited as authority, even as its spirit was hollowed out. The Civil War accelerated everything. Faced with existential threat, the government suspended specie payments entirely. Paper money, now unredeemable, flooded the economy. Greenbacks carried no promise of metal, only the authority of survival. Gold vanished almost completely from circulation, hoarded, traded at premiums, or hidden away. The visual contrast was stark, printing presses running hot while vaults grew silent. The emergency measures were meant to be temporary, but they revealed a deeper truth. Money could function without metal, if trust could be enforced. After the war, the struggle to return to sound money dominated national discourse. Gold was restored as the anchor, but silver's role remained contested. The Coinage Act of 1873 quietly ended the free coinage of silver, a move later labeled the crime of '73 by its opponents. To some, it was modernization, to others, it was betrayal. Yet the most significant change passed almost unnoticed. Monetary decisions were now being made by experts, committees, and financial elites, rather than simple statutory definition. The imagery of the era darkened. Gold sat behind thick steel doors, guarded, audited, abstracted. Paper claims moved rapidly across the country, settling debts and fueling speculation. Markets grew deeper, faster, and more volatile. Panics erupted with frightening regularity, exposing the fragility beneath confidence. Each crisis prompted more centralization, more coordination, more distance between money and the public. By the late 19th century, the Coinage Act of 1792 had become a historical reference rather than a living force. Its ideal of transparent metal-based money clashed with an economy dependent on elasticity and speed. Railroads, factories, and global trade required credit expansion that no fixed metallic base could comfortably support. The solution was not to abandon gold outright, but to manage it carefully, quietly, and centrally. This management created a new class of power. Bankers, treasury officials, and financial architects operated within a system that appeared lawful and stable, yet was increasingly insulated from democratic influence. Decisions about money were framed as technical necessities, beyond politics, beyond public debate. The complexity itself became a barrier. Few could see how the system truly worked, and fewer still could challenge it. As the century closed, the American dollar stood on a foundation very different from the one envisioned in 1792. Gold remained in theory, but its role was conditional, mediated, and strategic. The Coinage Act had promised a republic protected from hidden manipulation by grounding money in metal. Instead, it had paved the way for a more sophisticated form of control, one that relied on institutions, expertise, and distance rather than royal decree. The nation believed it still lived under the old rules. Coins still bore familiar symbols. Laws still referenced precious metals. But behind the scenes, finance had evolved into a layered system where access mattered more than ownership and knowledge mattered more than weight. The transformation was nearly complete. And as the 20th century approached, pressures began to mount that would test whether even this managed relationship with gold could survive a world of global conflict, industrial scale, and unprecedented financial ambition.
As the 20th century opened, the architecture of American money looked solid from a distance, yet inside it was under strain. Gold still anchored the dollar in theory, but in practice it had become a controlled resource, rationed through institutions rather than circulating freely. The Coinage Act of 1792 remained buried in the legal bedrock, invoked occasionally as tradition, while the real machinery of finance operated far above it, humming through banks, clearinghouses, and international agreements. What had once been a simple relationship between metal and value was now filtered through layers of management designed to absorb shocks and preserve confidence. Financial panics exposed the limits of this design. When fear spread, paper claims multiplied faster than gold could respond.
Banks, bound by reserve requirements yet pressured by competition, found themselves caught between law and survival. Each crisis revealed the same pattern. Gold was hoarded, credit froze, and the public demanded assurances that no longer aligned with reality. In response, coordination increased. Private bankers met in secrecy. Emergency funds were assembled. The system improvised, always in the shadows, always just out of public view. The creation of the Federal Reserve in 1913 marked a decisive turn. Officially, it was meant to stabilize markets and prevent panics. Unofficially, it centralized power over money in a way the founders had explicitly feared. Gold remained the foundation, but control over its movement, its deployment, and its psychological role now rested with a central authority. The Coinage Act's original vision of metal disciplining power had inverted. Power now disciplined metal. Inside the new financial order, gold became a strategic reserve rather than a public guarantee. Vaults grew deeper, more secure, more remote. Thick doors, armed guards, and meticulous inventories transformed metal into something almost ceremonial. For citizens, money was paper and confidence. For institutions, money was access to reserves and the ability to influence flows. The distance between these two realities widened quietly, rarely discussed outside expert circles. World War I accelerated this transformation. Governments across the globe suspended gold convertibility to fund total war. The United States emerged as a creditor nation, its vaults filling as Europe shipped gold in exchange for supplies. On maps and charts, gold flowed toward New York and Washington, concentrating power along with metal. The dollar's international role expanded, even as its domestic link to gold grew more symbolic. The interwar years were marked by uneasy balance. Officially, gold standards were restored. Unofficially, they were fragile. Central banks manipulated interest rates and gold flows to maintain stability. Markets became increasingly dependent on confidence rather than redemption. The Coinage Act's promise echoed faintly beneath this complexity, a reminder of a simpler rule now buried under necessity. Then came the Great Depression. Markets collapsed, banks failed, trust evaporated. The system built on managed confidence cracked under pressure. Gold once again became the focal point of fear and control. As citizens rushed to redeem paper for metal, the government faced an impossible choice: honor the promise and risk collapse, or break the promise to preserve the system. The choice was swift and decisive. Gold redemption was suspended. Private ownership of monetary gold was restricted. Citizens were ordered to surrender their coins and bars in exchange for paper currency. The metal that had once symbolized freedom from manipulation was now framed as a threat to stability. Images from the era are stark: long lines, official notices, sealed envelopes, vaults filling while hands emptied. With this act, the transformation that began in 1792 reached a critical threshold. Gold was officially removed from public life. The dollar remained defined in terms of gold on paper, but the public could no longer access it. Money became a closed loop, managed entirely within institutional walls. The Coinage Act, still technically part of the legal foundation, had been functionally neutralized. Internationally, gold continued to move, but only between governments and central banks. The Bretton Woods system that followed World War II formalized this arrangement. The dollar became the world's reserve currency, convertible to gold only for foreign states. Domestically, Americans held paper. Globally, the United States held metal. Power consolidated further, hidden behind diplomacy and technical language. This arrangement created an illusion of permanence. Post-war prosperity masked the imbalance. Trade deficits grew. Dollars accumulated abroad. Gold reserves slowly drained as foreign governments exercised their conversion rights. The system relied on restraint, cooperation, and faith, none of which could be guaranteed indefinitely. By the late 1960s, the strain was visible to those who knew where to look. Vault inventories tightened. Quiet negotiations intensified. Financial screens glowed with warnings invisible to the public. The promise that the dollar was as good as gold depended increasingly on no one asking for the gold itself. In 1971, the final link was severed. The United States ended gold convertibility entirely. The dollar became fiat money backed not by metal but by state authority and global confidence. The Coinage Act of 1792 was now a ghost, its definitions irrelevant to a system that had moved fully into abstraction. Yet gold did not disappear, it retreated further into the shadows. Central banks continued to hold it, nations continued to count it. In times of crisis, its presence still mattered, but it no longer constrained money, it no longer disciplined power. It served instead as insurance, a silent reserve against uncertainty. The journey from 1792 to 1971 revealed a pattern repeated throughout financial history. Rules designed to limit control eventually become tools of it. Transparency gives way to management. Public anchors become private levers. The Coinage Act was not forgotten because it failed. It was forgotten because the world it imagined became incompatible with the scale and ambitions of modern finance. As the 20th century closed, money had become entirely symbolic, infinitely expandable, and globally networked. Yet beneath the digital flows and abstract numbers, the old metals still waited in darkness, reminding those who held them that trust, once broken, is never easily restored.
In the decades after the final break with gold, the financial world entered a phase that the architects of 1792 could never have conceived. Money no longer needed weight, storage, or physical form. It existed as entries on screens, moving at the speed of light across borders that laws could barely keep up with. Yet the disappearance of metal from everyday life did not mean the disappearance of power. It meant its concentration. The discipline once imposed by gold was replaced by systems designed to manage perception, liquidity, and confidence on a global scale. Central banks became the silent engines of this new order. Interest rates, open market operations, and currency swaps replaced coinage ratios and mint standards. Decisions once measured in grains of silver were now measured in basis points and algorithms. To the public, these mechanisms appeared technical, neutral, almost invisible. To those inside the system, they were instruments of immense influence. Capital flowed not toward metal, but toward policy signals and institutional guarantees. The Coinage Act of 1792, with its insistence on tangible definition, stood in stark contrast to this reality. It had assumed that money should be understandable to the citizen, verifiable by weight and touch. Modern finance moved in the opposite direction. Complexity became a feature, not a flaw. The more layered the system, the fewer people could challenge it. Transparency was replaced by trust in expertise, and expertise clustered tightly around elite institutions. Gold, however, never lost its role entirely. It simply changed function. In subterranean vaults, beneath layers of concrete and steel, thousands of tons of bullion remained stacked, cataloged, and guarded. These reserves rarely moved, yet their existence continued to shape confidence. Central banks reported their holdings carefully. Markets reacted subtly to changes in those reports. Gold became the ultimate collateral, untouchable, unspoken, but always present. At the same time, a parallel system emerged beyond national borders. Offshore finance flourished. Dollars moved through jurisdictions where regulation was light and secrecy was law. Shadow banking expanded, creating credit outside traditional frameworks. Derivatives multiplied, layering risk upon risk in structures so complex they defied intuitive understanding. Value was created, multiplied, and insured against itself, often without direct connection to real economic activity. In this environment, the original fears of the founders resurfaced in a new form. They had worried about kings and private banks manipulating money.
Now manipulation occurred through models, leverage, and regulatory arbitrage. Control was exercised not by debasing coins, but by adjusting liquidity and shaping expectations. The public rarely saw the levers being pulled, only the outcomes: booms, busts, and bailouts. The financial crises of the late 20th and early 21st centuries revealed these dynamics with brutal clarity. When markets froze, central banks intervened on a scale once unimaginable. Trillions of dollars were created electronically to stabilize systems deemed too important to fail. Gold prices surged, reflecting a timeless instinct. When trust in paper systems wavers, metal regains psychological power. Yet even then, redemption was impossible. Gold could be bought, sold, traded, but it could not anchor the currency itself. Visually, the contrast is striking. On one side, glowing trading floors and data centers humming with activity. On the other, silent vaults, their contents unchanged for decades. The modern system depends on motion, on velocity, on constant circulation. Gold represents stillness, finality, and restraint. It stands as a reminder of limits in a world built on expansion. The Coinage Act of 1792 now reads like a message from another civilization. Its language is clear, almost austere. It assumes that money should be grounded, public, and constrained. That assumption no longer governs reality. Instead, money is governed by networks of trust enforced by law, power, and global interdependence. The act was not repealed in spirit, it was rendered irrelevant by scale. And yet its disappearance carries consequences. Without a tangible anchor, money becomes more responsive, but also more fragile. Crises are resolved through intervention rather than correction. Debt accumulates without clear boundaries. Inequality widens as those closest to the sources of money benefit first from its creation. The hidden financial world grows deeper, more exclusive, and more insulated from democratic pressure. Today, discussions of digital currencies, central bank digital money, and programmable finance echo the same tensions that surrounded the Coinage Act more than 2 centuries ago. Who defines money? Who controls its supply? Who bears the risk when systems fail? The technology has changed, but the questions remain. Once again, proposals promise efficiency and inclusion while raising concerns about surveillance and centralized power. In this context, the Coinage Act of 1792 serves less as a blueprint and more as a warning. It reminds us that money is never just a tool of exchange. It is a structure of power, shaped by those who design its rules and those who can bend them. When money becomes too abstract, too distant from public understanding, it invites control that operates beyond accountability. As the camera lingers on aged documents, their ink faded but their intent unmistakable, the story comes full circle. The law America forgot was not forgotten by accident. It was left behind because it constrained ambition. It demanded limits in a world that increasingly rejects them. Yet in moments of crisis, when trust fractures and systems strain, the logic behind it resurfaces, quietly, insistently. The hidden vaults, the offshore ledgers, the silent reserves of gold all testify to an unresolved truth. Even in an age of digital finance, power still seeks something solid beneath the surface. The Coinage Act of 1792 tried to place that solidity in the triggering hands of the public. Modern finance keeps it behind locked doors. And in that tension, between openness and control, between metal and abstraction, the real legacy of the Coinage Act endures, waiting to be rediscovered by a world once again questioning what money truly represents.